Welcome back, grade 12 learners. We are still busy with revision of the income statement. Before the break, we had just completed adjustment number 4, and we are now going to proceed to adjustment number 5. Adjustment number 5 reads, the provision for bad debts must be adjusted to 4% of good book debts. Now, some of you would normally want to use this amount of the debtors control, forgetting that there were certain adjustments that came before this one that affected the debtors, which means this is no longer the balance of the debtors. You must calculate the new balance of the debtors. And how are you going to do that? We're going to say 521,300 minus the 15,000 of the goods that were returned, minus the 675 of additional bad debts, and add back the 2,400 of bad debts recovered that was subtracted by mistake, which means the new balance will then be 521,300 minus 15,000 minus 675,000 plus 675 rands plus 2,400, which means now the new balance of our debtors is 508.25 rands. Is 508,025 rands. It is now this new balance that you must multiply by 4%. And then we multiply by 4%, which is 0.04. It gives us what? It gives us 20,321. This is the new provision for bad debts balance. And then you compare it with the old provision. This is the new balance. This is the old. Now you see the old balance was 22,000 and the new is 20,321, which means we must decrease the provision. And by now, you should know that when the provision for bad debts decreases, it must be recorded as an income. Therefore, you'll go to your income statement, and under other operating income, you'll write provision for bad debts adjustment. And then you have 22,000 minus, this is the old balance, minus the new balance of 20,321 that we have just calculated. And the difference would be minus 22,000. We have 22,000 minus 20,321. You adjust the provision with 1,679. Therefore, the important thing to remember here is 1, do not use the old balance of the debtors control. If the debtors control was affected by other adjustments, you must first calculate the new balance and multiply by the percentage that is given. Compare the new balance of the provision with the old balance. If it is less than the old balance, it is an income. If the new balance is more than the old balance, then it will be an operating expense. I'm sure that is clear. Let us move on to the next adjustment. The next adjustment is an easy one. Very easy. That everyone can be able to get those free marks. A physical stock count on 28 February reflected trading stock on hand, 1,531,000. Now, immediately, this is the stock that we have according to physical stock taking. And then we must compare this with the stock according to our records. According to our records, how much stock must be there? We must have 1,534,000. Instead, we have how much? Instead, we have 1,334,000, which means some of the stock has disappeared. Therefore, that is a trading stock. deficit. Then you will go to your income statement. Under your operating expenses, you will write trading stock deficit. Because according to our books, we must have how much stock? We must have 1,534,000. We must have 1,534,000. But instead, according to fiscal stock taking, instead we have only 1,531,000. Therefore, minus 1,531,000, which means a stock of 3,000 to the value of 3,000 has disappeared. Which means that the stock to the value of 3,000 has disappeared. What we simply did, this is according to our records from the pre-adjustment trial balance, minus according to fiscal stock taking, it gives us stock that has a trading stock deficit of 3,000. Fine. Like I said, that one was easy. Now, here they said on hand, but here they say consumable stores used for the year, 39,000. Consumable stores used, 39,000. Right, which means what? Which means this is the amount for the year, 39,000, which we must record here, 39,000. But how much did we purchase? We purchased 39,500. Now this will tell you that 500 is still left. Because we purchased 39,500, we used 39,000, which means only 500 is left on hand. Right. Next adjustment, which will be our adjustment number 6, deals with depreciation. Remember, yesterday we dealt with note number 3. I'm sure you will find this very simple after yesterday's lesson. They say depreciation is calculated as follows. Vehicle is calculated at 20% per annum on the diminishing balance method. A new vehicle was purchased on 31 December 2013 for 300,000. This has been properly recorded. Now, what does that mean? It means now this amount of vehicles of 880,000 includes the new vehicle. Therefore, in order to calculate our depreciation correctly, like I said yesterday, you must divide this 88,000 into new vehicles and old vehicles. Now, total vehicles is 880,000. Of this, a new vehicle of 330,000 was purchased during the year, which means now old vehicles would be 550,000, which means old is 550,000, new is 350,000. This is total vehicles that we have. Right. Now, with this information, we can be able to calculate depreciation on the new vehicles and depreciation on the old vehicles. Let's start with the old vehicles. Old vehicles, we said cost price is equals to 550,000. Remember, method of depreciation, they said it is on the diminished balance, which means we must subtract accumulated depreciation. What is our accumulated depreciation on vehicles? It is given to us there, 164,000. Then we subtract 164,000. And there we go. We say 550,000 minus 164,000. It gives us a diminished balance of 386,000. Then now, because we have this balance, we can now calculate depreciation. They say it's calculated at what? 20%. Multiply by 20 over 100. And these were old vehicles. These are old vehicles, which means they were used for the whole year. You multiply by 12 over 12. Then, which means we have 386,000. Multiply by 20%. That gives you 77,200. That gives you 77,200. You go to your income statement. You open up your depreciation. And then you say depreciation, how much did we calculate? 77,200. 77,200. Right. Then you come to the depreciation on your... No. I think we made a slight mistake. The new vehicle that we bought is 300,000.